Hello, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. We also have Brent DeGroot, regional marketing director of OneAmerica, joining us. So thank you, everyone, for attending today's session. Of course, as you know, we are going to be reviewing OneAmerica's hybrid long-term care insurance portfolio. Now, this isn't just product training. During the session, we want to show you some sales opportunities that just may be what your clients are looking for. Now, we did include a guide on their overall portfolio, so make sure to take a few moments to download that. As always, at the end of this session, we want to answer any and all questions you may have, so simply type those questions in the chat box of this presentation, and again, we're going to address those at the end. So, Brent, let's get started.
Wonderful. Thank you, Brittany. Really appreciate the introduction there, and thank you, everybody, for coming out today. I'm trying to deal with a little bit of a cold. Hopefully, I'm on the down backside of it, but if I just disappear for a second, it's probably because I'm on a coughing spell, so I'll be right back with you. But hopefully, we won't have any of those issues. But yes, really happy that Art Jetter and Company and Brittany specifically asked me to present today. And I really wanted to go through some asset-based opportunities when planning for long-term care. So happy you're all here. I figured I needed to start just with a little info on OneAmerica. We are an asset-based LTC market leader in this space. We were one of the first to come out with these types of solutions. As a matter of fact, our first asset care, which is our life-based chassis, first iteration of it was sold back in 1988, the year I graduated from high school. I can't really forget that. So, but we can trace our roots as an insurance company back to all the way to 1877. So, been around a long time. AM Best, we're A+ rated. Comdex, current Comdex is 95. So, all that speaks to the financial strength of who we are. Again, we were innovators in this space, and we've got ways that all differentiate us from the competition as well. And, certainly that goes to joint coverage, lifetime benefits, and many funding options, if you will. Some of that can be overwhelming, but I'll try and simplify it as much as I can. And we are a mutual company. We're very committed to this marketplace. And, so you don't have to worry about talking to your clients and making sure that, this company is going to be around. We've been doing this, again, now 35th year, and plan to be here for at least another 35, if not more. So, again, thanks for joining. I always like to start with the concept of self-funding because, you've probably heard a number of people say, well, this is the biggest objection. This is the biggest objection to long-term care planning. Well, really, it boils down to the concept of self-funding. And if they're self-funding, okay, maybe that may be their plan. Most of the time, it's just because they haven't created a plan. But if they're self-funding, they're taking directly from that same savings portfolio that they planned for retirement. That's earmarked for retirement. They didn't think about a health issue, an extended health concern that may cause more income needs for those expenditures. So when they're self-funding, they're taking directly from that same retirement portfolio that they've earmarked for retirement. And so why is that important? Well, this is a pretty well-balanced portfolio here in this pie chart: conservative, aggressive, moderate funds. But here's what we do. The concept of self-funding, well, I'll get into that in just a minute, but the concept of self-funding is pulling from that same portfolio. So let's say that a client has a $100,000 a year claim, if you will. That may not affect that whole portfolio overall. So not a big deal there if it's just 1 year of care. But what if they start to have multiple years of care? You can see how quickly that whole portfolio could get eaten up if, we're talking a 5, 6, 8 year claim. And not only that, here we're talking maybe that's just one person's expenditures. What if it's two people now taking out of this? So why the self-funding concept really doesn't work is because those funds are earmarked for retirement, other needs in their retirement years. So we've got a concept here using life insurance with LTC benefits, and this is kind of how we really determine or the best way to maybe cover any of this LTC planning. And basically, we're going to tap into that same portfolio, but only take out a portion of that early on to create a plan. So we'll maybe peel some from the conservative area. We're going to leverage that up in the term of a life insurance policy. So we'll leverage the amount that they give us as far as the premium, leverage that up to also create their long-term care benefits, if you will. And then we've got a rider structure, which we call our continuation of benefits, that can guarantee up to a lifetime. And that really differentiates us from our competition. We're the only one out there in the asset-based world that has that lifetime protection. So again, what's nice about this, we also have a joint policy structure where we can take one person's funds or the couple's, create this life insurance plan, and have them both access those benefit dollars and cover them both for a lifetime. So that really sets us apart, and it really puts the true peace of mind in, whether it's an individual or a joint policy design that you're working with. So if you've got those joint clients, that true peace of mind comes with knowing that they're never going to run out of benefits. The likelihood is fairly high that they're going to need some sort of services in their lifetime, but nobody knows how long that's going to be. Maybe if it's one spouse needs it for 2 months or 2 years, or maybe it's 20 years, you just never know. And if you're planning only for the average, you could easily exhaust that policy. Well, now we've got two people. So if one person exhausts the whole policy, that leaves the other with nothing. So now we're covering two people up to a lifetime, and it really puts that peace of mind in play for the clients. A couple other things that I really like to talk about with this as well is that there's guarantees built in this process as well. I worked in the traditional market for, 18 of the 21 years that I've been working in long-term care. And probably one of the biggest objections that I ran into past the self-funding was, hey, I don't want to pay for premiums forever and then never use this. Well, the benefit of using a life insurance with LTC benefits is you've got a guaranteed cash value, guaranteed built in, a guaranteed death benefit built in, guaranteed long-term care benefits. Oh, and on top of that, these premiums are also guaranteed. So you're never going to have your client call you up and say, hey, I got this rate increase letter. What do I have to do with that? So just thought I would quickly mention that. Now, here at OneAmerica, we have a lot of ways that we can create these types of plans. And I've heard from numerous people in the field that, you have so many options that it gets a little confusing. Well, I'm going to try and boil this down as simple as I can. I like things simple, and so hopefully you'll resonate with this little illustration here as well. So basically what we're doing is creating a base policy when we're creating a long-term care plan for the client. So that base policy can be either a life insurance contract, which we call asset care, or an annuity contract, and that differentiates us from our competition as well. We have both chassis that we can use from, and I'll kind of differentiate between the two as we go through here and where to use one versus the other. I will tell you, right now, our changes have been just a little bit around the business mix, and so we're seeing more of a asset care about 80% of the time and annuity care about 20% of the time. So thought I would just hit that up front. So the base policy, but remember, that's their asset. The reason we call these asset-based policies is because they're going to use their asset first, but then we can add a rider so that if they exhaust that asset that they have, that base policy, that can continue that same income stream specifically for long-term care expenditures for up to a lifetime. Most of the illustrations you'll see from me today will include that lifetime rider because, again, we differentiate there and really feel that that brings the total peace of mind for clients. So very simply, You'll see this base and rider type of illustration through some of these examples that I'll be using. But if you can get this concept, you've got us down. It's a base policy, their asset. They're going to use that first, but we put that catastrophic rider on to really continue those payments if they exhaust that base policy. Now, the best part about that too, if they never use their policy, that's when we fall back on that death benefit that's available, and that would be passed on to their named beneficiaries. So they're always going to get something for the premiums that they put into this LTC planning solution. All right, so let's look at an asset care example. Here's Paul and Melissa. Paul's 61, Melissa's 60. I'm going to show you a couple different ways that we can do this. And this particular solution right now is one that we're seeing a lot of. And I'll tell you why here in just a little bit. But let's kind of walk through this illustration, and I'll give you some insight after that. So we're creating a single premium. Here you can see the 100,000 single premium to create this base policy. Well, we leverage that single premium up. That gives us a $233,087 as far as a death benefit. We're both going to be accessing that. So both Paul and Melissa get access to that death benefit. We accelerate that death benefit at a 3% margin. When we're doing couples, we're almost always going to do it at a 3%. It maximizes the LTC benefits that are available for them. So you can see down below this arrow here underneath the base policy, that's going to afford both Paul and Melissa almost $7,000 per person per month in terms of LTC benefits that it will pay out on a monthly basis. Now, not only that, we've also added our unlimited COB rider, that continuation of benefits rider, here on the right-hand side. So should they exhaust that base policy, that whole $233,087 as far as a death benefit, whether it's one, whether it's both of them, that's when the continuation of benefits kicks in. And we'll continue that same income stream specifically for LTC expenditures up to that nearly $7,000 per person. Now, they both could be on claim as well. And if they are, it's going to pay double. So they'll also drain that death benefit quicker, so it won't pay out over 33 months. If they're both maxing it out, we're going to pay 16 and a half months essentially from that asset that is theirs, their life insurance plan. But the quicker they exhaust that, the quicker they're into really the insurance company's money with the continuation of benefits. So I like to point that out. Now, I mentioned we're seeing a lot of this design right now because what we did is we put a single premium into the base policy here, but we're going to annual pay the continuation of benefits rider. Now, why would you do that? Well, obviously it affords more to go into the death benefit, giving a larger death benefit in case they never use it, and a larger LTC monthly benefit per person. When you pay for it on a monthly basis, you're going to pay ongoing, and in this particular example, it's pay to age 95, which is our annual pay option, but we've broken it down here into a monthly premium payment. So $389 per month is what they're going to pay for the continuation of benefits. Now, you can see 61 and 60, they may be paying that for a while, correct? Here's one of the nice things with our asset care premiums as well. We have waiver of premium built into these plans. So let's say Paul in 15 years happens to go on claim. Well, that will stop this monthly premium going forward as long as he is on claim. So there's no premiums due while one or both of them are on claim. So we're seeing a lot of this makeup. It really makes it a little bit more maybe palatable to consumers out there. With everything that's going on in the economy, I just think that it makes a lot of sense, and the waiver of premium certainly doesn't hurt as well. Now, let me look at a different example here for the same clients. Paul and Melissa still here, but we're going to just do a single premium and pay for both the base policy and the COB rider, but we're going to split that between the two. So we've got $87,666 going to the base policy. You can see where that does reduce the death benefit, because before we had the whole 100,000 going to that death benefit, creating a larger death benefit and a larger monthly per person LTC benefit. But we're doing this a one and done simple solution this way. So the remaining $62,334 is going to the COB rider. So what did that do with the lower death benefit? It doesn't quite pay out as much per person, but again, it will continue that same $63.91 for either one of them as long as they would ever need coverage. Again, total peace of mind there is available. Now, I haven't added any inflation to these illustrations. I could really go in and make this stretch a couple hours, and I know we don't have that time allotted today. So for ease of it, I did not add any inflation, but we do have inflation that you can add to these types of planning designs as well. You can add it to both the base and the rider, or we're seeing a lot of just adding it to the rider, so that will keep up with inflation over time as well. So thought I would mention that. Now, there's another idea that we have, and not a lot of advisors and insurance professionals know that it's available out there, but we can use qualified funds, and you may have many clients that have qualified funds amply available to them. I mean, if you look at it, most Americans are saving in these types of vessels. So whether it's a personal IRA, whether it's a 401k, 403b, whatever that qualified solution is, that's where America is saving. And you can see as of 2020, 8.8 trillion in assets are in defined contribution plans, so qualified solutions. So why is this a good option? Again, not many advisors or insurance professionals understand that you can do a very simple solution using qualified funds. And so for the consumer, we can cover two people with just one person's retirement dollars. Always a good thing to think about there. We don't have to necessarily pull from both of them. We can utilize some of those idle dollars. They're just in their brokerage accounts growing, or maybe not growing right now because of the economy and the way the market has been certainly taking a downturn. We spread out the taxation, and I'll get to that here in just a minute, because we are going to be taking a qualified fund to a non-qualified source. So I'll get to that here in just a minute. And I'm going to also hit on RMDs and inherited IRAs. So bear with me a minute on that. For you as a producer, an advisor, insurance professional, look, your clients have plenty of these funds out there. As I said, 8.8 trillion in defined contribution plans. And it's a great way to spur more sales opportunities. Whether you even just mention that we could use qualified funds with your clients, and maybe they find, money elsewhere. So it's a good door opener that way, or they truly want to use some portion of their qualified dollars. So great way to generate more sales. Let's look at a couple things here. I'm going to give you another case study here. So here we have Peter and Martha. They're both age 65, married couple, recently retired, but they know they need LTC. So they haven't done any planning at this point for it. They would prefer to reposition a lump sum. So take a portion of their retirement portfolio, reposition that, and in this particular case, we're going to use $200,000 from Martha's 401k. Whether that was the full thing or just a portion of it, I don't know, but that's what happened in this particular case study. So we used $200,000 from Martha's 401k that she had. The reason that they wanted to put this long-term care planning place in play is because, they recognize Martha's family history. There's a lot of longevity there. And so they wanted to make sure that they had a good plan in case, one of them or both needed care. They were also inquiring about RMDs. Now, obviously, they're not RMD eligible at this point, but they were just kind of wondering, what about those RMDs when I reach those age of majority? And we'll touch on that here in just a minute. So here again, we're using qualified funds. So we're using, and I like this little illustration here of this hourglass. It's not coming down sand by sand. It's actually coming down in 10-year chunks, which I'll show you here in just a minute. But I think the hourglass really does a good job of describing maybe what we're doing here. So again, Martha's current IRA of 200,000, 401k of 200,000, and we're going to bring that over the direct trustee to trustee transfer. So moving from whatever qualified source that Martha had into a qualified annuity here at OneAmerica. We're going to give that a bonus right off the bat, a 25% bonus. Who doesn't like bonuses? So that 200,000 now becomes a $250,000 pool that we can create a base plan with our lifetime rider. So instead of just 200,000, now we've got the 250,000 that we can draw from. So that is in the qualified annuity here at OneAmerica. This is a simple one and done solution. Now, because I mentioned earlier, we are going to be taking it from a qualified source to a non-qualified source by funding this base life policy and the continuation of benefits rider. There is taxation that will happen. So we're going to break this $250,000 up into 10 equal parts. So over the next 10 years, there will be a distribution from the qualified annuity at OneAmerica to fund the 10-pay base and rider solution. That distribution, this $25,000 that we're talking about here, will create a taxable event. The clients will get an LTC 1099 for that amount for those 10 years. So if you're doing any tax planning, make sure that you're aware of that. And also it's very good to mention that to the clients, that they will be getting this tax bill because we're taking it from a qualified source to a non-qualified source. And look, the IRS is going to get their money some way, somehow, and that's the way we're doing. But we're actually spreading that risk out over 10 years versus doing it all in a one lump sum hit. So let's look at what that really creates. Remember, we had Martha's 401k of 200,000. We leveraged that in the terms of the face amount or the death benefit of their base policy. So leverage that up. Now a death benefit of 225,123. But remember, we gave that 200,000 a bonus of 50,000 right off the bat. Great little marketing piece there, or certainly something to mention to your clients. Again, everybody likes a bonus. We split that $250,000 into 10 equal portions and fund that 10-pay base and rider solution. So it includes both the base policy and the rider. So what does that create for them? $67.54 in a monthly benefit per person. So again, if they both happen to be on claim, this could be paying out over $13,000 in LTC benefit dollars. But you can see on an annual basis, that's over $81,000. Now let's look, how long does it really take to recoup that $200,000 from Martha's 401k? Well, we're talking under 2.5 years. So that would be split between the two of them because this is covering both of them. Really good solution here. Now let's look at just kind of some of the output here because I think that that's important to know, and I do get some questions around this, so I like to point this out. First and foremost, if we start on the left-hand side here, this is actually page 3 out of our quoting output. The ledger on this on the right-hand side is page 4, but I'm going to start on page 3 because I think that this really does a good job of illustrating exactly how this plan is working. Now, the biggest question I get is the total initial premium because it shows the $25,000 because we've broken that $250,000 up into 10 equal parts. So that is truly the premium, $25,000. But we gave you $200,000. Yes, but that's not part of the premium illustration here. So I just wanted to make sure that you're aware of that. when we show this, that is with the bonus broken out into 10 equal parts. So that initial premium is $25,000. We'll look at that further into the ledger page as well. You can see the face amount here of $225,123, divisible for both of them. They both have access to that face amount of that base policy for any long-term care services that they have. If we jump down to this next little bar segment here, it shows that face amount is payable for long-term care. But then if they exhaust that policy, that's when that continuation of benefits kicks in. I call this the catastrophic risk, and that's put on the insurance company, in this case, OneAmerica. Further down, if we go in here, again, it breaks out how much per person and how much it would pay out if they're both happen to be on claim. I also like to talk about the premiums. So the single premium annuity that came over, again, remember, she gave us the $200,000. Well, it actually works out $199,999. So that's where we show the initial amount coming over. We also break down the life portion and the LTC premium separately. The reason that we do that is depending on how these clients file, the LTC premium can be deductible. I don't have time to go into that today, but again, you've got a great staff there at our Jenner & Company. Reach out to Brittany. She knows exactly what I'm talking about and can help you with any of those ideas. We also break out the features and benefits. As I said, I didn't add any inflation here, but as guaranteed cash value and waiver premium is built in because we are doing a recurring premium over those 10 years. So now let's jump over to the ledger page. You can see that the $25,000, or really $24,999.92, is coming out each of those 10 years. That's what they would generate that 1099 for. But you can also see the cash value in this particular policy will be shrinking and then eventually growing up to the full $225,123. So it has this cash value that's available for them on surrender. The reason it shrinks early on is because we've got surrender charges that are built in on the 9-year chassis. So just understand that will shrink over that time and then start to grow with the interest that is gained. Total death benefit. I like to point this one out. Now remember, we have a death benefit of $225,123. And if we get past year 8 here, you can see that it finally gets to that $225,123. Well, why is it higher early on? I like to point this out. This is a joint second to die contract. But let's say year 3, they both perish in a car wreck. Horrible situation. But what happens is not only the full face amount of this policy would pass on to their named beneficiaries, but anything remaining in that qualified annuity would also be passed on. So the total payout to the named beneficiaries would be $354,678. So that's why you're seeing a shrinking value here until it reaches the full death benefit. Total unlimited balance there, LTC benefits, unlimited. And again, I didn't add any inflation, so these numbers are going to match up all the way down on the base policy, the AOB portion, and the continuation of benefits portion. So hopefully that explains exactly how that works. Now, I really like this. Again, if you think about it, the majority of U.S. savings are in qualified dollars. Why not use a portion of that? And lo and behold, we're going to give a great 25% bonus. Great planning option for long-term care needs. We spread that taxation out over the 10 years, but again, remember, your clients will get a LTC 1099 over those 10-year period as well. It is RMD friendly. Now, I told you I would come back and talk about this. So again, these clients, Peter and Martha, were 65, but eventually they'll turn the age of majority at age 72. When they do, if they've done well in their life and don't really need their a lot of their qualified funds for income, they can actually use that distribution, that $25,000 that is coming to fund the base and rider solution, and that is RMD friendly, so that can count in their RMD calculations. So another good way to look at this is even for those later in life who failed to plan and won't need their RMDs, also need LTC protection. So very much an R&D friendly solution here. And again, simple, one and done solution. Waiver of premium is built in, and I didn't talk about that. Let's say that, Martha in year 7 goes on claim. Well, that's going to stop the premiums due on the base policy. So that extra $24,999.92 would go directly to the family, and they can use that for extra care. So as long as she's on claim, that waiver kicks in. So a couple really nice things with this policy design. And then inherited IRAs. We all know the Secure Act was enacted back in 2020 or 19, I think it is. And what that got rid of was the stretch IRA, meaning that any non-spousal inherited IRA must now be drained in 10 years. Well, this solution fits really well with that 10-year drain because it is a 10-pay solution. On top of that, the Secure Act said that if they are under 59 and a half, there is no 10% penalty. So we can actually do that for people that are under age 59 and a half to avoid that 10% penalty. I will say this, our software will let you run this solution at age 55 and above, but we really say it's a 59 and a half and up solution just because we don't want people to incur that extra 10% penalty from the IRS. All right, now I need to move into the second portion here, which is our annuity side. And I've got some quick statistics. I'm not going to dwell on these, but again, another vast market is out there, $2 trillion in retirement annuity assets. Just in 2020 alone, 219 billion were sold. And what's the average age that people are buying these? Age 51. So a couple reasons that I mentioned that, and I'll get more into those when I'm going through these illustrations here. But there's really 4 main reasons why people buy annuities. One, just the growth, tax-deferred growth, right? Tax deferral, the growth, a guaranteed lifetime income stream. That may be some reasons that people use them. The 4th reason, to guard against a catastrophic illness. What is that? Basically, that we're talking long-term care needs here. So those are the 4 main reasons that people typically buy any of these annuities out there. Most of them are non-qualified. And I like to ask this question, or really beg you to ask your clients this question. Do they have non-qualified annuities that they've had in their portfolio for years? Maybe outside surrender charges or close to outside surrender. They're free and clear, but they've got a lot of embedded gain, right? So all kinds of tax-deferred growth in there. Why do I say is it where it should be? Because the Pension Protection Act really afforded us a great way of getting rid of that taxable gain in those non-qualified annuities. So think about this. How many of your clients will pass away with that annuity? What are they doing? They're just passing that tax liability onto their beneficiaries. How many are utilizing their income riders for their income needs? Again, they're just going to pass away, don't really need that income. There's ways that we can tap into turning on the income rider and funding an annuity solution with us. Now, Gallup poll, we pulled them a number of years ago, but it's really interesting to see these numbers. 83% intend to use their annuity to avoid being a financial burden on their children. What does that sound like? Again, long-term care. 73% intend to use their annuity as an emergency fund for any catastrophic illness or nursing home care. Again, very high statistics on why those non-qualified annuity owners would ever tap into these. So I mentioned the Pension Protection Act. This is a great way to help your clients get rid of some of their taxable income. And I like to use the slogan here, tax deferred to tax free for LTC. And what do I mean by that? Again, the Pension Protection Act really afforded us some great ways to plan for long-term care. Talk to your clients. What non-qualified annuities do they have in their portfolio that they're maybe don't plan to use or only plan to use for any catastrophic situation or nursing home type of situations? Why? Because if they leave it where it is at today, they have the cost basis of that original annuity. That's non-taxable. So whatever they took in non-taxable funds or after-tax funds and purchased that annuity, that's non-taxable. They'll get that out tax-free. But all of the gain in that contract is going to be taxable when they pull those funds out. So if they leave that there and only pull it out when they start receiving care, each one of those distributions, it's last in, first out. So each one of those distributions is going to be taxable until they get to the cost basis portion. So why did the Pension Protection Act, or what did it really do for us in long-term care planning? We can do a simple 1035 exchange from the original non-qualified annuity into a PPA eligible, HIPAA compliant annuity, which all of our annuity care products are, and I'll talk about those here in just a minute. And if they do that simple 1035 exchange, now when they tap into that for any long-term care needs, it's all income tax free. Great way to plan for long-term care planning needs. And we can add our optional continuation of benefits rider that I talked to you about earlier. Now, for those of you who have been working with 1035 exchanges for since they've been allowed, there is like for like rules. There's only certain ways that you can do these 1035 exchanges. Many times these non-qualified annuities may be singly owned. And if that's the case, we have a way that we can still 1035 exchange that, keep it in the ownership name of that original owner, so it's a legal 1035, but add an eligible person, so now we can have both spouses share in those LTC benefits. Many spouses want to share their benefits because nobody knows how long one or either of them are going to need those benefits. So a great little solution that we have here, even if it's a singly owned non-qualified annuity that we need to 1035 over. Now again, it must be a spouse. So we skirt the rules around the domestic partnership and that sort of thing. So those can be qualified as well. But again, it must be a spouse as the state recognizes. But now we can have both of them drawing from that plan, from that non-qualified annuity tax-free. Great way to help your clients rid themselves of some upcoming tax. And nobody wants to pay more taxes, right? All right, so here's some general case design best practices on our annuity care suite. And I'll get into that here in just a minute, the actual suite. But I wanted to give you some best practices around this. Package the COB and the premium with the annuity. So put it in a single one and done solution and forget it. So that covers both the base annuity and that COB premium as well. So no annual premiums due. It is proportionally paid. It would split between the two if they do that, and it does reduce that taxable amount in that base contract. Now, you can still set up a recurring premium for the COB portion. Why would somebody do that? Well, if you're going to put more into that base annuity, you're going to drive a higher benefit amount, LTC benefit amount, for those claimants. And many times people have health savings accounts, HSAs, and they can use maybe some of that to pay an ongoing premium for the COB portion. Just some food for thought there. And again, that 2-for-1 scenario. So still following the like-for-like rules in the 1035 exchange, but we can bring it over singly owned and then have both of those our policy owners then actually access those LTC benefits tax-free. So there's three different solutions. We've got our original annuity care 2, and indexed annuity care. Now, I'm only going to focus on the last two, but I always like to mention original annuity care as well. So we've got a couple ways that we can do this. We can just do a base policy. So 1035 exchange that to just a base annuity. Gives them access to that over 3 years in original annuity care. And we can do that all the way up to age 87. So if there's clients of yours that are being forced to annuitize, that may be a good solution for you, because most solutions you don't find out there are, above 80. Actually, our other two annuity care solutions are up to age 85, but we get an extra 2 years on original annuity care. That's as much as I'm going to say about that. But now I really want to focus on annuity care 2 and our indexed annuity care. So if I looked at the specifications of annuity care 2, you can see the ages here, issue ages from 40 to up to age 80. Now this one's a little bit shorter in its time frame, up to age 80. Can be single or joint. It's a deferred fixed annuity, has all of the same benefits as probably what their non-qualified annuity that they had already existing out there. But now by just 1035 exchanging, we can use those tax-free if used for LTC. So base-only solutions can be good. Now, annuity care 2 is one where we have the COB built in. So this is basically your straight leverage play, if you will. So if they've got a non-qualified annuity, they want a 1035 into annuity care 2, it's going to be both the base policy and the COB portion. And it basically equates to 2.5 times. So straight leverage play, pretty simple, easy to explain that way. I will say this, because the continuation of benefits rider is included in our annuity care 2 solution, the telephone interview, basically the cognitive portion, will be needed. So we've got an app, and I'll get to that app here in just a minute. It's a simple 5 knockout question app. But anytime you're adding the continuation of benefits rider, that telephone interview, that cognitive portion will be required as well. All right, just a quick hypothetical here. Female age 65 has $100,000, and we're going to put into this solution. So she 1035 exchanges that over. We give it an extra $150,000 essentially. So again, 2.5 times leverage, if you will. So now she has $250,000 essentially of benefit dollars to draw from over a 60-month period. So what did that equate for? $49,998 on an annual benefit, or $41,665 as a monthly benefit. So pretty straightforward here, just a straight leverage play, pretty simple. The index solution, and we're seeing a lot of this today, is a little bit different. So I wanted to give you a little bit more parameters around this. I don't remember if I mentioned the base policy, whether it's a joint or single. I don't think I did. So if it's a single, the base policy will pay out over 24 months. If it's a joint situation, it'll pay out over 30 months. So that's the same on annuity care 2 as well. But the issue ages change here a little bit under indexed annuity strategies. So from 40 up to age 85. Again, you just don't find any solutions out there that can go that high. Can be, again, single or joint. It's a fixed indexed annuity, so we'll gain interest the longer that they have it in that contract. They get to participate in all of the upside linked to the S&P 500. And we've got 5 different crediting strategies there. But what it also has is an internal mechanism that is growing the LTC benefits as well. And I say it kind of acts like inflation. So just wanted to kind of mention that as well. So not only will the annuity be growing, but the LTC benefits will be growing. And we're always going to give kind of the higher of the two for the clients. Now, this says tax-free here for LTC. It is all tax-free if they're going to be using it for LTC, unless they use the qualified annuity to 1035 exchange. So that's why we've got this little asterisk here. All right. With that, the continuation of benefits is out there as well. We can either double it, triple it, or add our lifetime rider as far as the COB. I know I'm getting low on time here, so let me fly through a quick example here. Female age 70 here, $150,000 coming in. We're going to split that between both the base policy and the COB. So it's paying for both sides of the equation here. So you can see the split there. What does that give her? Over 56,000, almost 57,000 is an annual benefit, or 4731. The rate equivalent that she would need to really equate to that same lifetime payout would be 37.8% annually. I don't know of any solutions out there that are going to be paying that. So great way to plan for long-term care here as well. Now let's put it all into the base and annual pay the premium. So the $150,000 instead is going just to the base policy, and we'll annual pay the base, the COB portion. So she's going to have an annual premium of $43.75. So just understand that that's how we're playing this out. But why do we do that as well? Why do we look at these sorts of situations? Well, it beefs up the LTC benefits for them. So this now pays $75,756 for the 70-year-old female, or $63.13 as a monthly benefit. But remember, she's got that ongoing annual premium for the COB portion that would continue that same $63.13 for as long as she would ever live. I mentioned we've got a very simple application with Annuity Care, simple 5 knockout questions. If they can answer no to all these questions, we basically do a script check and an MIB check. And if there's nothing else, if they didn't add the COB, if it's base only, we do those 2 script and MIB check, and then we usually turn to accept or reject, and we turn those around in 72 hours. If they did add the COB portion, obviously there will be that telephone interview for the cognitive portion as well, besides these 5 questions, but pretty simple to qualify with Annuity Care. So now what? I say it all starts with questions, or really a conversation with your clients. And I think that that's where so many people, they like these solutions, but they get hung up and they never start the conversation with their clients. And it all starts with a conversation. And I'll give you 2 simple questions that you can use to get the ball rolling. As advice givers, sales professionals, whatever it is, our hardest job is to ask a question and not answer it for our clients. But here's the question. You may never need care, but if you did, how would that affect your family? And at that point, our job is to sit and wait for their answer. We'll have to sit through that awkward pause, but that's going to give you the buying signals that why they really want to put these types of plans in place. And it really starts their head thinking down this path. And there's a number of things that we can talk about here. I'm not going to spend a lot of time on them because we just don't have a lot of time to go over that. But can the spouse truly care for the other one? Do they want to put the burden on the children? It can create really devastating family dynamics when maybe one is sharing more of the caregiving burden than the others. And you can never necessarily protect against unnecessary losses. But again, question 1, you may never need care, but if you did, how would that affect your family? Wait for their answer. Then question 2, and if you did need care, how would you pay for it? And you're going to get a variety of answers here as well. Many people still think that the government's going to pay for them. Unfortunately, that's just not the case. Maybe they have a traditional long-term care policy in place already, or maybe that's what they were thinking to certainly qualify. Once they know that these asset-based solutions are out there, many times they may look to that because they can get something for the premiums that they're paying for. And really, it's just a different way of self-funding. They don't have to do it necessarily dollar for dollar out of their pocket or out of their savings. They've got now leveraged amounts in these asset-based solutions. So very simply, 2 questions to ask, that gets the ball rolling. I'm going to give you one other resource here, experiencecaresolutions.com, that if you like to do, emails to your clients or put a link maybe on your own website, you can certainly do so here. And this is going to give some great information. This is basically what the landing page or the original page when you click on Experience Care Solutions looks like. Yes, it is OneAmerica branded, at least there at the top, but very interactive site. When they get to the end, it'll basically say, all right, here's your call to action. Are you ready to take the next step? Well, reach out to the person who gave you this information. Hopefully they'll remember who gave them this information. And we can actually take that a step further by registering you for a free resource at OneAmerica. Call our OneAmerica marketing store. And with that, we can give you a customized version of this as well. And so when they come to that ready to take the next step, it actually has your information. Yes, it wouldn't be mine. It would be your information there listed. So great way to do any kind of email campaigns, call out campaigns, just providing them information to kind of plant the seed, if you will. So what to do next? If you have any clients that you would like to talk to about a quote, I went over a lot of stuff today, but make sure you reach out to Brittany or any of the folks there at Art Jetter & Company. If you want a customized website, again, I would say really talk to Brittany. She'll put you in touch with me, or we'll get that set up for you. You can certainly reach out to me too if you want, but Brittany is a great resource. Want to learn more about our plans? We've got Friday trainings that happen every Friday, and you can certainly sign up for those. And I know Brittany does a great job of putting that out to all of the producers in their hierarchy. So hopefully you already have seen those, but if not, you can certainly come to any of those training series. Look, I would love to connect with you on LinkedIn. So if any of you would like to connect as well, you can just take out your phone, scan that QR code there, and we can connect that way. Or again, reach out to Brittany and we'll figure out a way to get connected. So with that, Brittany, I do want to open it up for any questions in the remaining time that I have left here.
All right. Well, Brent, I definitely appreciate all of the information you covered today. And it looks like we had some folks come prepared, because we definitely have some questions. Now, I know you've talked the majority of the time, so I'm going to tackle these first few. I'll give you a chance to get some water and rest your voice here. So first and foremost, state availability. Currently, right now, OneAmerica, sorry, New Yorkers, it is not available in the state of New York. I wouldn't hold my breath. We don't know when that's going to get approved, if New York will ever approve it. Outside of that, OneAmerica's portfolio is available in California, but I want to note that their asset care portfolio is slightly different. California still has an older version of asset care, so some of these functions look a little different in that state. If you do have clients or you're in California, like Brent said, call me. I can go over those variations with you. Next up, we had some folks asking about training. And yes, pretty much you can't sell any type of insurance without some type of training or certification. So if your state requires long-term care partnership training, that will need to be completed. And there's a handful of states that don't require it, but most do. On top of that, if we're looking at the annuity-funded asset care or that annuity care portfolio Brent went over, there is going to be the NAIC or best interest suitability training, depending on your state, as well as product-specific training. So if you're looking at any of these solutions, of course, speak with us and even our licensing team, and we can make sure you're okay to take that application. All right, next up, and I'll take this one last one, and then we'll get Brent on board with some of these other questions, underwriting classes. So for those of you familiar with the hybrid life, long-term care, or asset-based solution world out there, you probably know most carriers, you're either in or you're out. The only underwriting classes we're really looking at is tobacco or non-tobacco. Now, OneAmerica does take this a step further, and this is by allowing clients to be table rated. Now, we don't like table ratings. I understand that. It just simply means that they're less than standard. But that's giving us the flexibility to offer folks long-term care insurance coverage that may not be able to get it anywhere else. So typically with the table ratings, we do advise underwriting pre-screens. We've got an in-house underwriter. His name's Sean Whittington. If you have questions on a particular condition, or you're working with a client who's on a handful of meds, diabetic, sleep apnea, previous cancer history, Sean and I will help you in shopping that around, not only with OneAmerica, but with our other carriers to see what our best options are going to be. All right, Brent, are you ready to come back on board? Because we had some folks do their research on OneAmerica.
Excellent. Yes, I am.
All right, so first question up for you. Does the premium decrease at all on the second to die joint policy once the first spouse dies, assuming the second spouse is not on claim yet?
Yes, so great question, and it's a little in depth, but let me go through a couple scenarios. So let's say the first spouse that died used all of the death benefit in their joint plan. At that point, it's a fully paid up policy. No further premiums would be due. Now let's say that first spouse only used a portion of the death benefit. Once they pass, premiums would start again, but it would be adjusted based on the amount of death benefit that is left for that other individual. So there's a case where that premium could start again, but it would be a reduced level. If they never accessed the death benefit, the premiums would start up again and be exactly the same as they were when they started the plan. If they have a premium.
Awesome. Well, next up, looks like somebody's looking at that product guide. We've got the question, what is the non-forfeiture benefit for OneAmerica? What is that, an additional rider, and what does that do?
Yeah, so we do have non-forfeiture. Do I see that added to our policies? I'm going to say it's less than 1%. I don't think it's well worth it because of the benefits that it really gives. So at this point, I'm just going to say don't add it, just because it's extra cost that really doesn't get them a lot of extra benefit. So my strong recommendation, don't worry about the non-forfeiture. We've got contingent built in, but adding the extra cost for the non-forfeiture just doesn't make a whole lot of sense. I'd rather added in inflation.
And I fully agree with Brent. I think I've maybe quoted non-forfeiture once in my career on OneAmerica, and like Brent said, use those dollars in a better manner, whether that's, putting more into the inflation rider or just more in the overall benefits. But definitely we can talk one-on-one if you truly want to get in the details of that non-forfeiture benefits. Another good question come up, partnership qualification. So unfortunately, these hybrid long-term care life and annuity policies are not considered partnership qualified. You're only going to find that benefit within the standalone or traditional long-term care insurance policies. Now, I don't have an answer on why the government doesn't see these as potential partnership qualified options. Brent, have you heard anything about that?
Well, I know that some states are looking at it. Most of work through the NAIC, and so the compact states and so forth have been looking to see if they could do that, but I've not heard a whole lot of movement with those states through the compact for that. So yeah, at this point, they're just not partnership eligible.
And if that ever changes, we will definitely be contacting you all, because that will be a great and big benefit for people out there. So if those rules do change, you're definitely going to be hearing from our office. All right, looks like we just have two more questions and then we'll be able to get it wrapped up. So Brent, does the waiver of premium start at initial claim or does the elimination period have to be satisfied first?
Yeah, great question, because I didn't even talk about our elimination period. So elimination period does need to be satisfied first, yes. Our elimination period is 90-day of service for any facility side. However, most people want to receive care at home. That's where most claims start. And we have a 0-day elimination period for home health care. So if they are receiving care at home, then premiums are waived right off the bat. Now, any days that they are receiving care at home also count towards that facility side as well. So they're not only waiving premiums from day one, but should they need to move into an assisted living facility or full-blown nursing home, those days that they received home health care count towards that 90-day elimination period.
Well, perfect, because your second half of that answer answered the other question that was coming up regarding the 0-day elimination counting towards into the 90 for that home health care. So you read their mind and got that question answered. So overall, I want to thank everybody for joining us on today's session. Brent, you did a wonderful job. I love having you on. As we've mentioned, if you think of any other questions or you've got a specific client in mind, feel free to call the team or shoot us a quick email. Our contact information is on the screen. Also, keep an eye out in the next coming few weeks for the invite to our March long-term care insurance First Friday. That session will be hosting Lincoln Financial regarding their MoneyGuard solution. So I'll let everybody get back to their afternoon and look forward to speaking with you all soon. Thank you.
Thank you all. Thank you, Brittany.